Welcome to our Stock Market Investing for Beginners series on Everything Money channel. I'm Paul, that's Mo. We're here to teach you about the very basics of stock market investing. Now, one thing that's important here, even though I'm more advanced, I still to this day go back and read the same basic things over and over because my goal is to rinse and repeat and make sure that I understand the basics and stick to the basics, because in investing, the great thing is you don't need a lot of intelligence. You just need to have very good understanding of some basic principles and repeat them in your head. So it's 2023. In 1996, 1997, I started investing in stocks. And just like everybody, I was into hype. The back of my head, though, I always thought to myself, it doesn't make sense just to buy something and watch it go up. But I still did it. And then I lost a lot of money in the dot-com crash. And over time, I started to read more about Warren Buffett, and now it made me into a value investor. And I used to be 100% ETFs, and over time, I slowly became an individual stock market investor buying individual stocks. Mo, what's been your path?
So 20 years ago for me, I was sitting in my high school freshman year economics class, and we were playing a stock market game. And I started trading. And that's how I was introduced to the stock market. And as time progressed, as I started to make more and more money, I said, there has to be another way to deploy capital, not just trading. That's when I started getting into investing. Then I started finding out, Warren Buffett, Benjamin Graham, and getting into the value investing world. And here we are.
So why should you invest in stocks first? Mo, what would be your first comment? Because I'm sure we'll have different reasons to invest in stocks.
I mean, for me, it's a job. I mean, it's a way to make money. That was one of the things that really stood out for me when I started beginning, is that I could sit at a computer, I could study companies, and I could invest in them and make money off of them.
Yeah.
That was one thing for me. But I also wanted the opportunity to buy pieces of really good businesses, of products that I use, products I don't use,
at reasonable prices.
At reasonable prices, exactly.
So for me, I have real estate, I have businesses, and I have stocks. Real estate and businesses are wonderful. I get a higher return from my real estate and businesses and stocks, but they also require more work. Mm-hmm. Stocks are a great way that if you can find good companies at good prices, that you can just let things ride out. And it takes a lot less effort as time goes on. Doesn't mean there's no effort. There's still effort in stocks, but it's the best way to deploy capital, that if you understand what you're buying and you understand the value you're purchasing, and if you're able to purchase at a price lower than the value and have the patience, you can just sit back, relax, and watch your wealth grow. And there'll be ups and downs. It's not meant to sound easy, but that's the real reason why you should buy stocks. And over long periods of time, stocks far outperform bonds. I believe actually the stat is over a 20-year period, there's never been a situation where bonds outperform stocks. And I don't think there's ever been a 20-year situation in which stocks haven't made money. So a lot of people think the stock market is reserved for rich people, which is not true at all.
Not true at all.
I always tell people who are having kids, start day one, start putting $100 a month into their account. $100 a month into their account. Mo, have you seen what $100 a month in the stock market can do if you just put it in a low-cost ETF for 40 years?
Yeah, and the funny thing is you hear $100 and you're like, okay, well, that really doesn't do anything. When I go teach high school kids, I say, guys, put in $25, $50, $100 if you can per month. It is amazing what the compounding does over a long period of time, especially if you start when you're 16, 17 years old.
Yeah, exactly.
Or if your parents start for you when you're day one.
You should. 9% return. Over long periods of time, the S&P has averaged with dividends 9.9% annualized return, not average, annualized. If you do $100 a month for 40 years, that comes out to $468,000. So just keep in mind, you did 480, that's 40 years at once a month, times $100. You invested $48,000 of actual money, and you almost 10x'd it just by doing $100 a month. What happens if you do 1,000 a month? Well, add another zero. That's simple. That's how great $100 a month can go for you. Now, it gets even crazier. If you start a child out at age 0 and give them $100 a month to age 65, it comes out to $4.5 million at $100 a month. Now, of course, if you're out there and you know what inflation is because you have not been living under a rock, that 4.5 million is not worth 4.5 million in 65 years. But let's just say, hypothetically, it's worth $500,000 in today's money. Come on. And it's only $100 a month. So even in year 65, you're only doing $100 a month. That's it. What's $100 a month in year 65? $12 today? not even $10, that's the key to all this. That's how much little amounts of money can grow so large.
Yeah.
And it gets your kids understanding savings day one.
Right.
Isn't that incredible?
And that's the importance of that 9.9% return of the stock market over that long period of time.
Right. Now, you'll see all the time in the media, lots of ups and downs, news, this is bad, this is good. That's what we say to people. When you find a good company and you can buy it at a good price, just let it ride out and just make sure your thesis is still in place. So what do I mean by that? Make sure they're not doing anything crazy. Guys, quarter to quarter, companies are going to miss, companies are going to hit. There's going to be good news and bad news. Just look at history. Just look in your lifetime how many bad things have happened in the economy, how many good things have happened. And guess where stocks have gone the entire time? They've gone like this. Now, the path there is like this. And at this point, it feels like nothing can go wrong, nothing can go right, nothing can go wrong. And at this point, it seems like nothing can go right. But that's the key here. There's an old saying, it's more important to be time in the market than timing the market. What does that mean, Mo?
You want to be in the market for as long as you possibly can. And that 0 to 65 that he just showed you is why you need to. Because if you start going and trying to buy at the trough or buy it or sell at the peak, it's not going to work out for you. There's been many studies that show like if you miss the 20 best days of the market over a 20-year period,
it wipes your returns out in half.
Obliterated.
Yeah.
Yeah.
Absolutely.
So that brings us to what is a stock? You hear all these crazy things. It's very complicated. But when you really break it down, it is one piece of a business, one share of a business. So look at it this way. I always like it to put it this way. If you are going to buy a piece of Apple, you are buying one share of Apple. It's about $190 a share right now. You actually own, when you own that one share, the same thing that Tim Cook owns, the same thing that Steve Jobs owned at the time when he was alive. So you are actually buying a piece of that business. You are buying a piece of the company's cash flows that are coming in. You're buying a piece of the company's debts that they have to take on. Say you have a friend that has a landscaping company and you're going to partner with him and you go 50-50. Well, you own 50% of that business. If you were able to buy 50% of Apple, it would be the same instance. It's just one share, one piece of that business. And that's something that's very important. People have to understand that you're not just buying a ticker symbol that goes up and down. You're buying something that the cash flow, the sales of the company, the sales of iPhones, it really does impact you and it impacts your investment over a long period of time. That's something you need to understand.
And if your neighbor said, hey, come buy my landscaping business, what are you going to ask them for?
You're going to ask them for their financials.
You're going to ask for the profit and loss statement, the balance sheet, all these things. Yet we see so many people who buy these companies just saying, well, this product's really good, so I'm going to buy it. It's like, wait a second. Your neighbor could have a wonderful landscape business. You see all of their awesome work. Does that mean you pay them $10 million for a business that generates $500,000 a year in revenue? That would be just as ridiculous.
Right.
Okay, so that's what we're trying to encourage people to do here. Once you get behind the idea that when you buy a stock, you buy a piece of a business, it becomes a lot easier to handle the ups and downs. This was absolutely paramount for me in part of my transition. When I started to realize that as long as I bought a company that I thought would make more money down the road and I paid for a reasonable price today, I was going to make money. Yeah. That was the big key. So the next thing you need to know is what's market cap. You hear this probably all the time if you paid attention to any sort of news. Market cap is very simple. I pulled up Microsoft on our software here. The very first item we have here is market cap, and it's very simple, guys. What it does is it takes the price of the stock and multiplies it by the number of shares they have outstanding. And on our software, you can find the number of shares outstanding at the very bottom of our income statement. 7.44 billion shares outstanding. So obviously we don't need you to do that math. We do it for you. Now, one thing I want everybody to remember, one of the basics of stocks, don't focus on this. If the company had one share outstanding, it would be $2.6 trillion. If they had 10 shares outstanding, it'd be 2.64 trillion divided by 10 or 264 billion. Look at it this way. Let's pull up a company like Berkshire Hathaway. So remember, Microsoft has a market cap of 2.64 trillion. Berkshire Hathaway, Class A shares, they have $677 billion market cap. That's 1/4. That means Microsoft's worth 4 times more. But look at their stock price. This is not a typo. $462,000 per share. They just divide up the number of the value by a lot less shares than Microsoft. That's it. That's all they're doing. They're not trying to play some fancy games.
Right. So something important. Don't look at a company and say, oh, this is $10 a share. This is cheap. This is $100 a share. This is expensive. That's not the way that you should look at a stock.
Yeah. Don't look at a company and say, this company's $10. This company's $100. Therefore, the $10 company is cheaper. It is not necessarily cheaper. It is. I would much rather have Berkshire Hathaway at $462,000 than Tesla today at $300. That's the point I want everybody to understand. It's a very hard thing to put your head around because you see these huge numbers. You're like, wait, what is going on here? But that's the point. That is the difference between understanding what you're buying. You're buying a piece of a business and you're buying a market cap. This is what the market is saying the value of the company is.
There's things called stock splits, for example, and I don't want to get too advanced, but if Berkshire Hathaway came in and said, we're going to do a 10-to-1 stock split, they're going to issue 10 times the amount of shares out there.
Correct.
And then the stock price will look cheaper.
It'll go down to $46,000.
But the market cap will still be exactly the same.
Exactly the same. So guys, why do companies issue stock? This is important for you to understand. That's why we're going to go over this now. Companies issue stock because they want access to capital. That's it. Let's say you own a business at home, or your neighbor has the landscaping business, and they grew it and grew it and grew it, and the business is worth $10 million. Well, how do they get that $10 million out of the business? Well, they can't. Why? Because just because the business is worth $10 million doesn't mean they have $10 million in cash sitting there. And that's why companies go public. It allows them to access that cash very quickly. If they want to sell their $10 million business right now, it'd probably take them 6 months to a year. But if they go public, they could sell it like that. They could sell shares like that. They could sell $500,000. Let's say they wanted to buy a new house. They could sell $500,000 of their shares. That's why companies go public. They want more access to capital. And to be honest with you, it's also far sexier to go public. It's like, oh, look, I'm the CEO of a publicly traded company. People know how much I'm worth, etc. It's a bunch of baloney. And I personally think going public can actually hurt more companies than it can help. There are 3 major ways in which you can invest in the companies and the indices in this market. Mo, go ahead.
So we've talked about stocks. You can just go buy a stock. You're buying a piece of the business and you're going to watch that ticker symbol, the price, go up and down. The second way is a mutual fund. You might have heard about these. They're very popular on television. People are always trying to sell their mutual funds. It's active managers that are picking stocks for you. And the study has been shown 80% of those don't beat the market.
On a year-to-year basis, and over 10 years, it's like 98% or something crazy don't beat the market.
And when I say don't beat the market, it doesn't beat the S&P 500 that returns the 9.9% over annualized return. Now, those settle at the end of the day. So you can't just go and buy that at 12 o'clock noon and that's the price that you're going to pay. Like a stock, if you go buy a stock for $190.49, you're getting it at $190.49. With a mutual fund, it's going to settle at the end of the day. Those tend to be more expensive as far as fees go because you do have an active manager. Now, my preferred way and your old preferred way was ETFs, exchange traded funds. Basically, it's a conglomerate of stocks that they put together and it's there to manage your risk. And the best way of doing this is when you, as a beginner, go and look at the S&P 500. Go and look at a Vanguard ETF because it's a conglomerate of the 500 companies that make up the S&P and they're pretty cheap. The expense ratios are very, very low on those.
The S&P 500 ETF, SPY, has an expense ratio of 0.09%. The average mutual fund is 0.75 to 1%. Now you might sit there and say, well, it's only 1%.
Doesn't sound very big, but
when we have videos on this. When you do this over long periods of time, you're talking about $2 million in difference between performance and fees because these guys also don't even beat the market. I always laugh when I hear people say like, oh, the experts who run these mutual funds. And I'm like, what experts run mutual funds? They're there to collect fees. They're there to charge marketing fees, have research analysts, all these things happening that you're eating up for, as opposed to just match the market. For every $10,000 you invest, do you understand this is only $9 while this one is $100 per year? $9 per year, $100 per year. This matches the market. This one trails the market. Which one would you rather have? All right, guys. So please watch our next video. We're going to talk about 4 very important things. First off, how do stocks go up and down in the short run and the long run? Very different things will drive stock prices in the short run and long run. 2, the 2 different kind of stocks, growth versus value. Okay? We're going to talk about how they're very similar actually, but people always separate them. 3, what is risk? You must watch this video for what is risk because I have a very, very different opinion on what is risk versus every other Harvard MBA in the world who I think is absolutely stupid. So you must watch it for that. And we're going to finish with how you as an individual can get to the point where you're beating the market over long periods of time. So guys, watch that video. You're going to learn a lot in those 4 different points.